there's almost an arbitrage play here that if the market comes down, these rents are still cheap. And if the market stays the same, I have a lot of upside. But what I can't do is just walk in and say to these tenants that are great tenants and great business owners, guess what? I'm here. I'm going to raise your rent. Well, I can, but I wouldn't do that.
Right.
So the flip side is we'll go in, we'll put a lot of capital improvements in the building, make it really nice. And then when the leases are up, move the rents.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Todd Nepola is the president and founder of Current Capital Management. They are a full-service management, leasing, and development company in the commercial, retail, and industrial markets. Todd, welcome to the show.
Hey, Sam. Thanks very much for having me.
Pleasure's mine. Todd, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Okay. Well, I started in Hollywood, Florida, buying commercial properties. Was the second question, where am I now?
Where'd you start? Where are you now? How'd you get there?
Where am I now? We're in a great position. We own and operate about 2.5 million square feet of commercial space, primarily in the retail and industrial sector, all of it located in the state of Florida on the eastern coast. And how did I get here? I got here from wanting to own cash flow rich properties, wanting to have stuff that was stable and keep me going forever.
That is really, really interesting. So you own all commercial real estate. Has that always been your focus? I mean, the first piece of real estate you ever bought was a commercial asset?
It's actually correct. The first piece of property I bought before I even bought a house was a commercial warehouse.
How did that happen? I mean, most people don't do that. That's pretty courageous. Tell us quickly how you got into that.
Well, I'll tell you, at that time, I was 25 years old and I was a stockbroker doing some investment banking deals. And I recognized that even though I was making great commissions because the 90s were great years to be in that business,
right,
I had to go to work every day. And if I took a couple of days off, I got paid zero. So I started looking for any opportunity I could to get into cash flow positive businesses. So I looked online and I looked not even online. I looked at newspapers and on TV back then. But everything was from selling ATM machines to you name it. But the one I kept on going back to was real estate because it paid rent every month. So in the 1990s, this was 1998, 1997, it was easy to buy commercial real estate. In fact, nobody wanted it. It was the ugly duckling back then. And I would drive by this property all the time and it really had a for sale sign and nobody called. And it was a foreclosed warehouse, 13,000 feet. And I called. It was owned by a bank out of Canada. We worked out a deal. Nobody else seemed to want it. And I purchased that building and I was 25 years old. I put every single penny I had into it. Everybody told me I was crazy and was going to lose my money. And I still own that building today and I'm glad I bought it.
I'm sure you do. Do. Tell me, what is the focus for you guys, from that point, until now? What do you focus on specifically right now?
Well, what we've always focused on is looking for value add deals. And I'm not one of these guys that says I have to find an extreme opportunity when I buy. I'm not looking for a discounted property. I'm looking for properties that have future upside. So either I want to get in the way of progress, whether it's either a road widening or building a hospital or something nearby or a new school, something that's going to add value, or I believe I could re-tenant the property over time. So one of those two things. Now, I pay up for properties as long as I believe it has that future potential. But of course, if you can find a deal, that's great. In the last few years, there are no deals, so you have to be a little more creative.
What are you doing when you look at a property and you say, okay, hey, I think we can value add or implement our value add strategy? What are you looking at when you see? I mean, because I think we talked about this, off air, that you guys are buying B and C class retail assets. What does value add even mean, first off, in that space? And then how do you identify those properties?
What we look for most is always where the upside could be. So I never want to say a property necessarily was mismanaged before we got there, because that's not always the case. I just want to say it wasn't carefully paid attention to. So we've had opportunities whereby we bought properties and we were able to add a few parking spaces on the side of the back and put additions on the building or add out parcels. We almost always go in looking for buildings from the 80s and 90s that just need a little facelift. Not necessarily a complete renovation, but maybe take down some of the old tile stuff that was popular in the 80s and put up some new modern marble and stone, little upgrades like that. Change out old lighting, put in LED lighting. So those are the kind of value add adjustments we're looking for. So we're essentially looking at the brand new shopping centers and trying to copy those with our 1980, 1990, even 2000 centers and bring them up to date as best we can.
That is really, that's really cool. What is, when you classify a B and C center, identify identify that versus, or clarify that versus what maybe even a class, retail center may be?
Sure. Great question. When people class centers as A, B, C, or even D sometimes, what they're basically doing is giving it a grade, so to speak. So you think of your Class A center, think of your brand new shopping center that was built in the last, 3 to 5 years, maybe 7 years, where the local grocer is there, the big name in our town is Publix, and it's followed by the Orange Theory Gym and Chipotle and Starbucks, and everything is just perfect and brand new. That's a Class A center. We don't go into that market because a Class A center, the money's made by the developer, and they're generally sold off to an institution or someone just looking for a yield. There's virtually no upside in that deal for us because it's perfect. It's got the best tenants, the highest rents, and it's brand new. We go into the centers that were Class A maybe 20, 30 years ago, and we try and spruce them back up and bring them to like a high B. So we're not going to get the best in class grocer anymore. We're going to get Dollar General who wants a cheaper rent. We're not going to get the hugest names in certain markets, say and some of them say Chipotle and Starbucks and Wells Fargo side by side. We may get a few more mom and pops mixed into the equation. But these are the centers that, the local people need to go to. It's your chiropractor, it's your dentist, it's your gym, it's your tax office. It's those kind of uses. So we're just a notch below Class A.
When you see a building, you say that has opportunity to add value to it, and it sounds like a lot of what you're talking about was more the cosmetic side of it. How do you know when you have made the building look a lot better, be more presentable for potential tenants? How do you know that you're able to fill it?
Well, generally speaking, the properties we buy, a lot of them are pretty full. So we always buy them with cash flow in place. I don't like to buy vacant buildings unless it's a single tenant use and maybe like a owner user moved out. So there'll be tenants in place. So the first thing we're looking for is, are the rents compatible to the market? So I'll give you an example. We just bought 2 properties about a month ago, and it was from the same seller who owned them for about 14, 15 years. Now, they were 100% occupied. Each building was approximately 40,000 square feet, and we bought them both for about $13 million combined. The issue was that the rents were substantially lower than the market because he's had tenants there for 15 years, 12 years, 10 years, and so on. So these tenants have baked in lower rents over time, whereby the market, this is in Palm Beach, the market has increased so much. There's almost an arbitrage play here that if the market comes down, these rents are still cheap. And if the market stays the same, I have a lot of upside. But what I can't do is just walk in and say to these tenants that are great tenants and great business owners, guess what? I'm here. I'm going to raise your rent. Well, I can, but I wouldn't do that.
Right.
So the flip side is we'll go in, we'll put a lot of capital improvements in the building, make it really nice. And then when the leases are up, move the rents, move the needle. We still want to keep them below market, but we want to just, we want to appreciate our, spending dollars too.
What is it when you look at these assets? What is a cash on cash return for you or for your investors? I don't know if you raise money or not, but what is a cash on cash return that you say, hey, this is kind of the minimum for us when we look at a deal?
That goes case by case because sometimes we buy properties that we have to redevelop and need a lot of work, so it'll be a longer time horizon. And sometimes we go in right at the get-go. Generally speaking, with interest rates so low as they've been in the last 2 years, we've been able to get cash on cash around 13 to 15%. So we've been doing pretty well in cash on cash.
Wow.
We have now been appreciating 3.25%, 3.5%, 3.75 interest rates. Deals right now that I'm looking to do a loan right now, what was 6 weeks ago in the 3s is now almost 5%. Mm-hmm. So now we need to see a pivot in either the pricing of the properties or something's got to give because you got to make up for those numbers.
Right. Yeah, you certainly do. And I guess that brings up an interesting question is, what if someone were looking at this asset class and wanted to scale into it, what does financing look like in the retail space? I think we have a pretty good understanding of what maybe it looks like in multifamily and things like that, but this is a unique asset class. So what is the financing, or what does the financing look like?
People ask me that question a lot. It's a very good question. I tell them that it's no different than buying a multifamily property or anything else. The bank is looking at the asset. And they're looking at the borrower to see if they have the ability to repay the loan and if they're good borrowers. But ultimately, the most valuable part of the equation is always, who are your tenants? Now, unlike multifamily, where most of the tenants in multifamily are 1-year leases, some even less, in my properties, I have some tenants we just did a lease with Dollar General. They have 40 years of lease. They have a 10-year deal with options for 40 years. So the bank is more concerned with Dollar General than me per se. But they still want to see if I'm a good borrower and a good boy and I'm going to behave and pay my bills. So you need a track record there. That and some money down. The days of coming up with these properties with 10 or 15% or 20% down, that's gone. You got to get into the mindset that realistically you need about 30% down to buy these kind of properties and have comfort from the bank.
Right. Absolutely.
Yeah.
Let's talk about that for a second. This is a question I've not really been able to personally answer. If you're signing a 40-year lease with Dollar General, how often, let me ask the first part of this question is, how often does that lease have rent increases built in?
This is the part nobody likes to hear because it's the truth. When you do a deal like that, Dollar General, Family Dollar, those guys, for example, they're such good credit tenants that they really control your property and they control the lease. So what they generally do is they'll give you a 10-year lease, and most times it's fixed for the full 10 years.
Wow.
So the only increases you're going to get are limited to how much your increases could be on your common area expenses. So if the real estate taxes can go up, you can't control that, but you must control the landscapers, the porters, all that kind of stuff. And that's capped. Then every 5 years thereafter, it's a very small increase. So we just did one, for example, where it's 10% every 5 years, but that's not even 2% a year when you base it out because they do it after 5 years.
Right.
So it's fixed. So they have a great deal.
Right.
The core with them is that you want to bring those guys in and they drive a lot of traffic and they have a lot of credibility. So it's easy when you have Dollar General who brings in, say, 300-400 customers a day, sometimes more, to bring in the nail salon, the cell store, and get the rents out of those guys.
Got it. Now that's a unique strategy, because that was my question is, how are you offsetting the inflation risk? I mean, that's something that's a very real problem I think you run into with a 10-year hold before you get any rent increases whatsoever, is you're eating that inflation, whatever that is, for the next 10 years. But I think you just answered it by creatively saying, look, we use them as the anchor. Maybe even they are your loss, and then hopefully not, but your loss leader in its own right, where it's like, okay, well, maybe we don't make much on Dollar General, but we'll capitalize on everything they bring in and make up the difference on all the other tenants in the space.
You're 100% right. And that's exactly how we view these guys, just like the grocery or the big box Walmart or whatever you want it to be. They're just driving the traffic and you make it up on the sides. With what you just said, thing that I keep getting asked is, I have a lot of friends that have professional careers, whether they're accountants or dentists, whatever they may be. And these guys got so caught up in buying triple net properties, but single freestanding ones. Right. So I have friends who bought Wawa gas stations and Starbucks single friend, and they were buying these things at 4.5 cap rates. And they thought they were so smart because they had cash in the last few years. And I'm trying to explain to them that this is really a horrible investment going forward. With CPI at 8.5%, your assets depreciating. And guess what? You don't even enjoy a rent increase for 4, 5, 6, 7 more years. Right. So I think you're going to see a big change there when people start to figure out that they didn't just buy a bad deal at 4%, that they're really falling far behind in the next few years. It's dangerous.
Certainly is. And it'll be interesting to see how those assets either reprice or how those leases are then renegotiated when they come up for renewal. So that's very, very intriguing. You're writing a book right now. And I think one of the things you told me off air was that everybody's asking the wrong questions. So as opposed to telling us what the wrong questions are, can you give us a sneak preview on what you see some of the right questions are as it pertains to commercial real estate and what it is you're doing? And then tell us a little bit about the book.
Sure. So the name of the book is called Keeping It Real on Commercial Real Estate. And I never want to say people ask me the wrong questions. Maybe I should be careful with that word wrong. I feel like they come up and ask questions, but like there's better questions they could ask. I never want to insult anybody, be rude and say, wait a second, don't ask that, ask this. So I decided to put a book together, and to show that I was being authentic to the readers and I wasn't trying to do something for myself, I said, I will give 100% of the proceeds to charity, but I really want to write a book because I want everybody involved in commercial real estate or even multifamily real estate like you do, because that's why the purpose of the podcast.
Right.
I want to see people come up and do this. I've been doing this now for 25 years and I love it. The issue I think people get caught up in commercial real estate is, for some reason, they think owning multifamily is just easy because they figured out how to buy a condo or a house, but they think getting into commercial is harder. And I'm trying to sway that thinking that, in fact, commercial is easier because I'm getting to deal with professional business people day to day that have to make business decisions. It's not really personal or emotional. So if I had a 10 unit or a 50 unit or whatever it would be apartment house, I have to deal with people who have personal decisions. Maybe someone lost a job. Maybe someone lost a family member. Maybe someone is sick. That's very challenging to me to have to deal with these obstacles. If I have a tenant who says their business is bad and they can't pay the rent, I just need to let them out of their lease and move on with their life. But in the other situation with residential, it's tougher. So the main thing I'm trying to instill to people is that commercial real estate is very accessible. You could get in the same way as residential, and to not be overwhelmed by those leases like with Dollar General, because the truth is just about everybody knows who Dollar General or Family Dollar is. We all know who Starbucks is. So writing a lease with them is pretty simple because we know who they are. When Mary or someone just walks in on the street and wants to sign an apartment for a lease, other than a background check you did for $50, you really don't know that much. So I'm trying to persuade people to get more and more into commercial real estate. That's my goal.
I love it. I love it. And one more time, what was the name of the title of that book?
The name of the book is called Keeping It Real on Commercial Real Estate by Todd Nepola.
Awesome. Looking forward to that coming out. And I think you said it'd come out here in the next 60 days or so.
Yeah. We're going to bring it out at the end of the summer.
That is awesome. Todd, I've enjoyed learning about your business and how it is that you guys look at retail strip centers, what you guys are investing in, how you guys are finding upside, protecting your downsides, and just how it is that you guys are finding opportunity and making it happen here in commercial real estate. Thank you for writing the book. Last question for you. Is there a charity that you've picked out that you said, hey, all the proceeds are going to, or is it getting spread across several charities? What's your thoughts on that?
Well, the main charity I'm involved in that this book, the bulk of the proceeds will go to, is called Crew Network. And Crew is set up for minorities and women to get involved in commercial real estate. And they're all throughout the U.S. I think they've been around for about 35 years. And it's got some very, very powerful people behind it that are spearheading this campaign, so to speak. And I kind of went there because I have two teenage daughters now that are 16 and 17 years old. And I said, there's such a small amount of women in commercial real estate. How could there be more? And there's nothing for me to reinvent. Crew's already done that. There's so few minorities in commercial real estate. Crew's already done that. So I want to partner with that organization, which is fantastic, and send the proceeds there and let them keep doing their job and I'll do mine.
I love it. Absolutely love it. Todd, if our listeners want to get in touch with you or learn more about you, what is the best way to do that?
We have our website for Current Capital. It's currentcapitalgroup.com. My Instagram is Life According to Todd. And if you want to reach me and ask me a question, my office number is 954-966-8181. I'm always happy to help anybody get you over the hurdle to buy your first deal.
Todd, I love it. Thank you for sharing today. Certainly appreciate it. And yeah, we'll make sure we put all of that information there in the show notes. Have a great rest of your day. And thank you again for coming on.
Thanks so much, Sam. I've appreciated this.